Shocking jobs report. Fed rate cuts coming soon? Labor market stalls in 2025. The U.S. labor market is in a far worse state than many realized, and this revelation could force the Federal Reserve's hand faster than expected. Imagine a scenario where the numbers don't just hint at trouble, but scream it. A jobs report that not only misses forecasts, but also exposes a months-long stall in hiring. And here's the twist. This isn't just about July's underwhelming 73,000 new jobs. It's about the shocking revisions to previous months, which turned robust gains into near-zero growth. But here's where it gets controversial. These revisions have sparked a firestorm of speculation about the reliability of the data itself. Could this be the final straw that pushes the Fed to cut rates in September? Let's unpack the numbers, the fallout, and the debates brewing in financial circles. The Labor Department's Friday report sent shockwaves through Wall Street. While July's 73,000 payroll additions fell short of the 100,000 forecast, the real eye-opener came from the downward revisions to May and June. May's figure plummeted from 144,000 to 19,000, and June's dropped from 147,000 to 14,000. A combined 258,000 jobs erased from the record. That's not just a miss. It's a rewrite of the labor market's recent history. The average monthly gain over the past 3 months now stands at a paltry 35,000. To put this in perspective, if these revised numbers had been released months ago, they would have completely shifted the narrative about the economy's strength. And this is the part most people miss. The revisions have cast doubt on the entire data gathering process. Eric Packman of Bank Creek Capital Advisors summed it up bluntly. How can we even trust this number now? The fallout was immediate. Stocks tumbled, with the S&P 500 dropping 1.6% and the Nasdaq falling 2.2%. Treasury yields, which move inversely to bond prices, plummeted as investors priced in a likely September rate cut. The 10-year yield fell over 15 basis points to 4.208%. While the 2-year yield, more sensitive to Fed policy, plunged nearly 27 basis points. But the controversy didn't stop there. President Trump, already embroiled in trade tensions, took a dramatic step. He fired Erica McIntyre, the head of the Bureau of Labor Statistics. Critics argue this move raises questions about data independence, while supporters claim it's a necessary correction to flawed reporting. What's your take? Should political leaders have the authority to overhaul agencies that provide such critical economic data? The Fed's next move is now the center of attention. Chair Jerome Powell has insisted on waiting for more data to assess the impact of Trump's tariffs on inflation, which remains above the central bank's 2% target. But analysts are growing impatient. Jamie Cox of Harris Financial Group warned Powell is going to regret holding rates steady this week. He predicts a September rate cut, possibly even a 50 basis point move to compensate for delayed action. Others, like Adam Hetz of Janus Henderson Investors, argue the revised data has already significantly increased the odds of a September cut. Yet, not everyone is convinced. Cleveland Fed President Beth Hammack defended the decision to keep rates steady, while Comerica Bank's Bill Adams pointed to lingering inflationary pressures from Trump's tariffs. This split in perspectives highlights a critical debate. Is the labor market's slowdown due to weak demand, or is it a supply-side issue? Here's the breakdown. If the problem lies in demand, the Fed should act swiftly. Weak hiring and rising unemployment could signal a need for rate cuts to stimulate growth. But if the slowdown is due to a shrinking labor supply, driven by Trump's immigration crackdown, and a 6-month drop of 1.2 million foreign-born workers in the labor force, then monetary policy may not be the answer. Preston Caldwell of Morningstar argues that a supply-driven slowdown doesn't justify rate cuts, as it doesn't create a gap in maximum sustainable employment. However, he admits the speed of the decline and the uncertainty around the data should argue strongly for a September cut as a prophylactic measure. The coming months will be a test of the Fed's resolve. If the next jobs report shows another drop in labor supply while tariffs keep inflation elevated, policymakers might choose to hold rates again. But if the data continues to sour, the pressure to act will mount. And for investors, the question is clear. Will the Fed prioritize inflation control over growth, or will it pivot to prevent a deeper slowdown? We'd love to hear your thoughts in the comments. Do you think September is the right time to cut rates, or should the Fed wait for more clarity?